Stan the Annuity Man, America's annuity agent, dressed in red, not because there's some warning signal, but maybe you're looking for an answer for annuities and long-term care, which is a really good question. A lot of people have that on their mind because long-term care is kind of that gorilla in the room, that little guy on your shoulder that's like, you might want to address that. You might want to check that box. I'm assuming that's what you're looking at, which is, can I solve this with annuities? Well, the answer is yes, you can. But I want to go deeper into that answer and show you some examples and tell you the products on how to do that, or maybe how to use an annuity to pay for the long-term care, which is also an idea as well. So hang in there with me and we'll get to it. Let me go grab my pen. Okay, so using annuities to pay for long-term care. Now, most agents are going to say, hey, I've got this great annuity that solves for long-term care. And it's guaranteed issue, you don't have to do anything, and maybe that's happened to you. The short answer to that is the best coverage still for long-term care is traditional long-term care. And I don't sell traditional long-term care. I'm America's annuity agent. I'm Stan the Annuity Man and licensed in all 50 states, but I don't sell long-term care, but it's still a great product if you can find it and it's affordable, etc. I do use a person that I refer that business to, that's a long-term care specialist. But when it comes to annuities and long-term care, there's a couple of products that are out there. One of them is an indexed annuity or variable annuity with an income rider that has what's called a confinement care benefit rider on it. It's guaranteed issue. And what you see typically with those is that it doubles for if you can't do either 2 of the 6 daily functions, some of them, and some of them it's some other parameters you have to hit in order for the income to increase. But in a perfect world, those type of products should be used as secondary coverage, not primary coverage. Here's what we're going to look at today, and this happened the other day. A gentleman called me and he said, I want to cover for long-term care, but I don't want to just take money out of my investments all the time. How do I do that? How do I take an annuity and pay for long-term care? Let me grab this pen, let me go get the board, let me wipe the board down, and once I do that, I'm going to show you how we solve that problem for him. Okay, long-term care, gorilla in the room, right? I know there's no perfect answer. There really isn't. And here's the other thing too, and I just thought of it. If the government comes in with some type of universal care in the future, I don't really know where long-term care coverage is going to go. There's not many companies left out there that even do traditional long-term care. But let's just say, here's your long-term care, and I don't sell that, but I could refer someone that's very, very good, as brutally honest as Stan the Annuity Man, which is what you want. You don't want someone just selling you something. So let's just say the premiums on that, and I'm just going to grab a number just for math's sake, is $200 a month that you got to pay for long-term care coverage. And a lot of people say, I hate long-term care coverage like that because, Stan, what if I never use it and all that money's gone to waste? I agree. I mean, that's an issue. But you do the same thing for homeowners insurance and flood insurance and car insurance. It's the same thing. I don't think you should look at it any differently. So here's what we did for him. So it was $200 a month. So I said, here's what we can do. We can take an immediate annuity and solve for that $200 a month. So reverse engineer it. You can run an immediate annuity quote 2 different ways. You can say, hey, Stan, here's the lump sum. What income stream is that going to produce? And by the way, it's based on your life expectancy at the time you take the payment. And the payment is a combination of return of principal plus interest. So I ran it 2 ways for him and had him decide what he wanted to do. I said, we can do it like this. We can say life only. And life only means it's going to pay you for the rest of your life, but when you die, money goes poof. And when you die, you don't need the long-term care anyway, right? Exactly. So we ran that quote for him, and let's just say for just math, this was $100,000. Actually, it was less than that, to be honest with you. Let's say it was $50,000 now that I'm thinking about it. It's $50,000, and it was going to pay $200 a month for the rest of his life, regardless of how long he lived, and it was going to fund that long-term care policy, okay? And then I ran it this way. I said, how much longer do you think you're going to live? Now, that's a loaded question, right? But the guy was pretty opinionated. He goes, I don't know, 10, 15 years. I said, okay, let's run a 10-year certain annuity. So 10 years certain, and what does that mean, Stan? That means that it's going to pay for 10 years, and after that, it's over, okay? So it was still good. We still solved it for $200 a month, but it was a little bit less. Let's say it was like $45,000 or $42,000. I forget what it was. Long story short, the 10-year certain was less than the life only. Why? Because it's for a specific period of time, and the life only was for, forever. Now, he eventually decided on the life only. He said, I'd like to do the 10-year certain because it's less money, but what if I live to year 11 and, I need the long-term care? Good point. And so what he did was this. He did life only. He did it for solving for $200. And what did he do? He did a turnkey approach to paying for long-term care as long as he was alive. The second he died, it was over. So I thought that was a good way to do it. I guess the downside to that is when he needed the long-term care, let's just say he paid into it, and we discussed this, but there's no perfect solutions. He turns on the long-term care, and that time happens. The $200 a month is still going to be coming into his estate as long as he's alive. I guess that's cool because there's still going to be a cost, etc. But that's an interesting way, kind of an arbitrage way to use an annuity to pay for a long-term care benefit that you want to make sure you have. Okay, so now you kind of understand how you can solve the problem. But what I want you to understand and think about for your specific situation is this. And these are just stats, and they're hard stats to kind of come to terms with, but it is what it is. In the long-term care world, when you qualify for long-term care, it's when you can't do 2 of the 6 daily functions of life. And those daily functions are stuff like feed yourself and clothe yourself and bathe yourself and things like that. And I know, I think of that, and you're probably thinking the same thing, which is like, man, when that happens, life stinks, right? I mean, agreed? So, but we have to think like that. You can't do 2 of the 6 daily functions. I just want you to go there. I know it's tough. You're going to live an average of 3 years and a maximum of 7. That's what the stats say. So when you can't feed yourself or clothe yourself or bathe yourself, you're not going to live long. Life stinks anyway, right? But from the standpoint of the coverage, average is 3 years, maximum is 7, and you might be sitting out there going, not me, I'm going to probably live forever and be drooling on myself and whatever. I understand that, but I just wanted to get your head around long-term care coverage is really for short-term coverage, because once you qualify for long-term care, it's kind of a rapid decline. And I know we're being a little morbid here, but we're also, me and you, talking honestly about the coverage. So what I would tell you to do is consider that. The other thing, put in the back of your head, this might be a little bit crazy when I say it, but it's true. Most people that have $3 million or more investable assets, you're either out there going, Stan, you're crazy, I don't have that, or I might have that. If you have that, you can pretty much self-insure, in my opinion. But even people with that type of amount of investable assets, they like to transfer risk, and that's what you're doing when you're buying a long-term care policy. So, those are some kind of things I wanted to talk to you about just the reality of long-term care and as you're going into the planning. And I would encourage you to contact us at stantheannuityman.com and let us put together scenarios for you and show you the good and the bad and the contractual guarantee so you can make an informed decision. All right, so we got a little down and dirty there at the end, but what I'd also like for you to do is there's a video I did called What is the Best Annuity for Me, which in essence is you, right? What is the best annuity for you? And I go through all annuity types and go through some scenarios that might apply to you that says, okay, if you need this, this is the annuity. If this is kind of what you're solving for, this is the annuity. So that's a good one. And after watching that, you can also contact us and have us put together a customized plan for you at StanTheAnnuityMan.com, where I have a podcast, The Annuity Man Podcast, on all platforms you might want to go to as well. And I put out these YouTube videos every single day, Monday through Friday. So subscribe if you want to get educated a little bit more than that. So from America's annuity agent, dressed in red, Stan the Annuity Man, I'll see you next time.